in some, there's a question that I gave you to try in our last class, which was yesterday, the one of May 2019. The one of May 2019. Of course, I know between yesterday and today, there have been quite a few hours in between there, given the fact that most of us are working during the day. We also have other engagements, families by the side, in this case here, to look after. But is there somebody who was able to just attempt that question? May 2019, is there anybody who was just able to attempt? Is there anyone who was able to attempt? There's nothing wrong if you say no. I just want to know whether there is anybody who was able to attempt something, however small. You know, it could be, there could be a possibility that all of you were able to finish the question, and as such, Mwalimu may not even do it. Response? Not yet. So when they keep quiet like that, chances are they never did the question. So I think I'm better off doing the question. So it's May 2019, question number 5. It's May 2019, question number 5. JESA, tours and travel. So we have here Advanced Financial Management, CPA, May 2019, question number 5A. Question number 5A. JESA, Tours and Travel, is a private company in the tourism industry. We did up to cash flows. We did up to cash flows. So can I start from cash flows directly? Is that will that be good for everybody? Will that be good for everybody, or I do it from scratch? I'm waiting for your response, kindly. Do I just get the cash flows, I discount them, or we do it from scratch?
From scratch.
From scratch.
Then another says start from cash flow.
So third person.
From scratch.
So from scratch. So you're told here, JESA Tours and Travel is a private limited company in the tourism industry. In order to improve customer service and provide the management with timely and quality information, the company is contemplating to purchase 8 microcomputers at a cost of what here? 100,000. 100,000. So the total purchase cost, of 8 machines, of 8 computers, each for 100,000. This gives us 800,000. That is the total purchase cost. Installation cost for all the computers will amount to 80,000. Installation cost for all the computers. So, ladies and gentlemen, we have here installation cost. Installation cost is 80,000. So, of course, installation cost must always be capitalized. Installation cost must always be put into the initial outlay. So we have here the total outlay. The total outlay is 880,000. The total initial outlay is 880,000. So you're told the installation cost for all the computers will amount to 80,000. It is estimated that once installed, the computers will increase the company's earnings before depreciation and tax from 12 million to 12.5 million annually. Therefore, the benefit here, once we bring on board these computers, ladies and gentlemen, our profit here will increase from 12.5 million, or rather from 12 million to 12.5 million. So the benefit of bringing these machines on board will be the 0.5 million, 0.5 million. That is the benefit. This benefit, they've told us, will increase the company's earnings before depreciation and tax. So this is the increase before depreciation and what you have increase in profits before depreciation and the tax. So we are told the computers are expected to last for 10 years, after which they'll be obsolete with no resale value, with zero resale value, with zero resale value, with zero resale value. We are told the operations manager proposes that the computers will be used for 15 years with no resale value. We have someone else in this case here, we're saying no, 10 years are too few. According to the operations manager, ladies and gentlemen, the computers here will have a useful life of 15 years. The marketing manager, on the other hand, argues that the company needs the computers for only 5 years, after which they can be disposed of at shillings 50,000 each. So we have some marketing manager saying that no, we can only make use of these computers for 5 years. And still, because 5 years are too few, we shall be having some resale value of 50,000 each. The probability distribution of the useful life of the computers is given as follows. So you can see the probability, we have the useful life of computers in years. The company is in the 30% tax bracket. So we have been given tax. Whenever we are given tax, depreciation becomes relevant. Whenever we're given tax, we must compute depreciation. We are told the company's cost of capital is 24% and they uses straight line method depreciation. They want us to give them the expected net present value of the project. And then number 2, the standard deviation of the expected net present value. Number 3, if the net present value of the project is less than 200,000, the firm will be exposed to a financial distress. So they want us to determine the probability that the firm will avoid financial distress, and they're telling us to assume a normal distribution. Assume a normal distribution. Ladies and gentlemen, the biggest mistake that most of the students who did this particular sitting made was to give us expected useful life. So most of the students went ahead and told us that the expected useful life from the table given on this, before this paragraph, last paragraph, or before required, there's a table given there of useful life. So very many students went ahead and did 0.2 times 5, plus 0.5 times 10, plus 0.3 times 50, and then they gave us an expected useful life. That one automatically put them offside. Offside, why? Because they got some useful life, and the useful life that they got, for instance, ladies and gentlemen, does not, or rather will not, for example, lead us to, like the one that we have here for 5 years, which has got some scrap value. Remember, they have given us some scrap values for different what year periods. So the best students, what the best students here did was to come and evaluate all those events separately. They went ahead and evaluated the events separately. So they did actually 3 columns. So we have here 3 columns. 3 columns. So we have our 3 columns here. We have our 3 columns. So they had a column here for 15, or rather for 5 years, 10 years, 15 years, 15 years, 15 years, 15 years. So, ladies and gentlemen, because they have given us, tax rate, the very first thing that I will do is to compute depreciation. And for me to be able to compute depreciation, I need the purchase cost, including in this case here, this installation. Purchase cost including installation, regardless of the useful life, this will be 880, and I hope you guys are able to see where the 880 is coming from. 880. The purchase cost for all the computers we computed was 800,000, and then to install this, we needed 80,000. So from there, come and give me the scrap value. Scrap values, if we will sell these machines at the end of year 5, you can see, ladies and gentlemen, they've given us scrap value. There is this particular note talking about marketing manager, on the other hand, argues that the company needs computers for only 5 years, after which they can be disposed of at 50,000 each. At 50,000 each. Remember, the computers in total were 8. So then 8 times 50, this gives us 400. Remember, this table of mine is in shillings, thousands. How about if we were to sell these machines after 10 years? If we sell the machines after 10 years, we're told there won't be any scrap value. The same applies, ladies and gentlemen, to 15 years. Now, given this, I should be able, the 3 factors, I should be able to give you the depreciation per annum. They have told us that we are depreciating our assets on a straight line basis. We are depreciating our assets on a straight line basis, on a straight line basis, on a straight line basis. And if that is the case, ladies and gentlemen, then straight line basis, we normally take initial cost minus scrap value divided by number of years, which are 5 years. Here I will talk of 880 minus 0 divided by 10 years. Here we'll talk of 880 minus 0 divided by 15 years. So, ladies and gentlemen, kindly give me these figures of depreciation. And again, I'm repeating, why am I computing depreciation? I am computing depreciation, ladies and gentlemen, simply because we have been given the rate of tax. So we have here 880 minus 400 equals, divided by 5 years. The first one gives me a full 96. The second one will be 88. The third one will be 880 divided by 15, which gives me 58.67. Could you kindly confirm that all these figures are correct? Kindly confirm those figures are correct. If they are correct, ladies and gentlemen, please come and double underline them. Come and double underline them, because now what I need is a cash flow statement. Remember, a cash flow statement for us, how does it look like? We have sales, we have costs. However, in this question, this examiner gave us the benefit of these computers. He gave us the benefit of these computers. He told us that once we bring on board all these computers, we have in this case here the increase in profit before depreciation and what year? Tax, which was coming to 500,000. You remember this? This was 12.5 million minus 12 million, which gave us 0.5 million, which is the same as 500,000. So in this case here, we have 500. We have 500 here. We have 500 there. 500,000 every year. 500,000, 500,000, 500,000, 500,000. Now, ladies and gentlemen, having gotten that, what I will do straight away, I will come and less my depreciation. I know there is that shortcut there, but I don't like it. I don't like it. I'll be telling you later on why. Just come and do it the traditional way. So come and less here, depreciation. Depreciation, we have the figures. We have 96 here. We have 88 there. We have 58.67 there. So come and deduct these ones for you to be able to give us what we call profit before taxation. So profit before taxation, what do we have here? We have 500 minus 96, which gives us 404. 404. We have 500 minus 88, which gives us 412, which gives us 412. 500 minus 58.67, which gives us 441. 441.33. Once I get these profits before tax, what will we do? We'll come and share this with our taxman. So come and share this with our taxman. So let's start. The taxation figure given there is 30%. The taxation figure given, ladies and gentlemen, is 30%. the taxation given there is 30%. So 30%, 30%, 30% of this. So we have here 441.33 times 0.3 because I already have this figure. So this one will be 132.40. So we have 404 times 0.3, which gives us 121.2. Then we have 412 times 0.3, which gives us 123.6. So it's a track like that. Ladies and gentlemen, the moment I do it that way, whatever I will get will be called profit after what here? Profit after taxation. So then profit after taxation, this will be 404 minus 121.2, which gives us 282.8. We have 412 minus 123.6, which gives us 288, which gives us 288.4. And then we have 441.33 minus 132.4, which gives us 306, 308, 308.93. Ladies and gentlemen, remember in that particular Zoom platform of yours, you have an emoji like this one. So if these figures are correct, you simply tell us, yes, they are correct. If they're not correct, there's another one which says like this. Yes. For us to continue, ladies and gentlemen, please give us a sign that things are okay. Otherwise, we proceed like that, and then at the end of the day, we get ourselves being wrong. Are we okay? Everyone type there yes or just okay. Today you guys are not like the way you were yesterday. Yesterday you are really making contributions. It's okay. Thank you very much. Now, ladies and gentlemen, if this is okay, having gotten profits after tax, ladies and gentlemen, straight away I would endeavor to change these to cash flows. How do I change these to cash flows? I'll come and add the non-monetary. Add the non-monetary parameter. The non-monetary parameter here is the depreciation. So come and add back depreciation. Add back depreciation, and our depreciations are here. We have 96, we have 88, we have 58.67. Kindly come and give us these figures, and whatever we shall get here will be called cash flow. Whatever we shall get here will be called operational cash flow. So we are adding back. So I'm armed here with my calculator. I will talk of 282.8 plus 96 equals. This gives me 378.8. And then we have 288.4 plus 88, which gives me 376.4. We have 308.93 plus 58.67 equals, which gives me 367.6. Having gotten these cash flows, the next thing I will do is to come and discount them. And if my administrator here is able to see my figures down here, I'll continue. I'll come and give you, for purpose of discounting, I'll give you the PVFA, present value interest factor of an annuity. So whatever we have is an annual figure. It's an annual figure because profits are annual parameters. Even the depreciation, you got depreciation per annum. So whatever you have here is an annuity figure. So like now this one, what I'll do, I'll come and read from my table the PVFA. PVFA, how many years? 5 years. What cost of capital? The examiner must have given us the cost of capital directly. The cost of capital given here, ladies and gentlemen, they gave us 24%. They gave us 24%. So here I will be reading PVFA, 5 years, 24%. This will be PVFA, 10 years, 24%. This will be PVFA, 15 years, 24% like that. So could you kindly give us these figures? Do we have 24% on our annuity tables there? Do we have 24% on our annuity tables? Do we have 24% on our annuity tables? Do we have 24% on our annuity tables? Do we have it or we don't have it? 24%, 24%. Do we have it or we don't have it? We have it. So go to the table called the annuity table. Annuity table, you read 24% up there. Move like this, ladies and gentlemen, we'll be able to see where our N, for instance, where our N is 5. And then I will read for us the figure that is there. The first one, 24%, 5 years. What figure are we able to see here, ladies and gentlemen? What figure are we able to see here, ladies and gentlemen?
2.7454.
2.75.
7454.
7454. Thank you very much. How about PV FAR? Still 24% up there, but down now 10 years. 10 years, down there 10 years. What do we have somebody as PV FAR?
3.66.
3.6.
619.
6. 1. 9. Thank you very much. Lastly, we have 24%, 15 years. 24%, 15 years. 24%, 15 years. 24%, 15 years. What do we have there, somebody? 4.00. 13. If you allow me, I'll have to transfer this figure somewhere. If you allow me, I will have to transfer this figure somewhere. I'll have to take them up here. I'll have to take them up here. So, ladies and gentlemen, what do we have here? We have our cash flows. We have our cash flows. We have our cash flows here. Our cash flows, ladies and gentlemen, our cash flows, we have here 378.8. Here 10, we have 376.4. 376.4. And then we have here 367.6. So you guys have been able to give me the PV first. You've been able to give me the PV first, present value, interest factor of an annuity. So the first one you've given me is 2.7454. So in this case here we have 3.6619, and then we have, ladies and gentlemen, 4.0013. 4.0013. So could you kindly give me the present value of operational cash flow, of operational cash flows? Remember, these are cash flows that are associated with what here? Our profits, they are operations. Operational cash flows. So present value of operational cash flows, what are we going to do? We shall come and take these multipliers. We multiply them. So we multiply them in terms of 2 decimal places. In terms of 2 decimal places, ladies and gentlemen, what we have here? In terms of 2 decimal places, what do we have, somebody? This by this.
1039.
1039.96. Thank you, and thank you very much. How about this one here, somebody? This times this, give us a figure. So we have this times this, give us a figure we write. 2 decimal places, don't forget. $1378.34. How about 15 years? When we multiply the 2, 15 years, what are we going to get at the end of the day here, ladies and gentlemen? $1470.88. Ladies and gentlemen, I could see very many students getting these answers correct up to here. But always, over 50% of the students will forget discounting of the scrap value. Scrap value is a future income, is a future cash flow that has to be discounted. So in this case, here come and give us the present value of scrap value, scrap value, scrap value. Present value of scrap values and gentlemen. Remember, like year 10 and year 15, we don't have any scrap. Year 10 and year 15, we don't have any scrap. We only have a scrap at the end of year 5. At the end of year 5, the scrap, if I remember very well, the scrap was 400. At the end of year 5, at the end of year 5, there's a marketing manager. On the other hand, we are told, argues that the company needs the computers for only 5 years, after which they can be disposed at 50,000 each. And remember, how many were they? 8. 8. So 50 times 8 is 400. But now remember that this income will come to this organization at the end of the 5th year. End of 10th year and end of 15th year, regarding resale values, we were told, ladies and gentlemen, that there were no any scrap amounts expected. So come here, present value of scrap, present value of scrap, take the 400 here, you multiply these with the PV. PV of 5, 24%, because you are getting this money at the end of the 5th year. So now this time round, if you're keen enough, I'm not adding A here. It's not a PV thing. It's a present value interest factor of a lump sum amount. Of a lump sum amount, yes.
We say on 38/7/10 year, PV is 3.6819, and therefore present value is 1385.87.
For how many years? For 10 years.
Yeah, 10 years.
For 10 years, there is somebody who is saying that this figure is not correct. For 10 years, there is somebody saying that that figure is not correct. For 10 years, there is somebody saying, thank you very much for that. For 10 years, it's supposed to be 3.68. Thank you for that. 3.6819. Please confirm this. Confirm that. Kindly confirm that. I've been able to use my calculator. I don't know why your tables were giving you different figures. Please confirm that. Can I have like 3 or 4 students saying straight away that now we have done the correct thing here? Can we have other students supporting this?
So I say correct.
Correct. Thank you very much. So now take this 376.4 times this 3.68. So we have here 376.4 times 3.6819, giving us 1385.87. Thank you, and thank you very much. How about the other figures? 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 Presumably they are correct.
Okay.
They are okay, thank you very much. Now come here, ladies and gentlemen. This scrap value arising from the 8 computers will be coming to us at the end of the 5th year. At the end of the 5th year. So please go to those tables of ours, 24%, 5 years. What are we able to get here? Somebody 400 times PV, 5, 24%. What do we have? Somebody there? Somebody 24%, 5 years. If I wish, I can also use my calculator. 1 plus R, raised to negative n. So I'll talk of 1.14, 1.24 actually, raised to negative 5, which at the end of the day will give me 0.3411. So 400 times 0.3411. So could you kindly give me that figure? Kindly give me that figure. Kindly give me this figure. Kindly give me this figure. Kindly give me this figure. So we have 400.
36.4.
136.44. So this is 136.44. We have said here the others are what here? Zeros like that. And then of course, if I'm a good student, what I will come under do here is to add so that you can get the total present value. Total present value. These other two, I'm quite cognizant of them. These other two, we have here 1385.87, 1470.88. But of course, this one I have to pick my calculator and add. Plus 1039.96, ladies and gentlemen, which will give us 11, which will give us 1176.4. So having gotten the total present value, what is it that we shall do? What adjustment shall we do here for us to be able to ascertain the net present value? What adjustment? I'll come and less the initial outlay. Less the initial outlay. The initial outlay, we had a figure of 880, 880, 880. It doesn't matter how many years these computers will stay with us. It doesn't matter. So come and subtract. And of course, once you subtract, you'll be able to give us what we call the net present, what here? The net present value. You'll come and give us the net present value. So minus 880 equals, which gives us 296.4. 296.4. We have 1385.87 minus 880, which will give us 505, 505.87, 1470.88 minus 880, which will give us 590.88 like that. So those are the net present values, ladies and gentlemen, that we happen to be having there, Yes. Now the next thing that I would want us to look at, ladies and gentlemen, if you read the question very well, they want us to give them the expected net present value. Expected net present value. So remember, here there are three possibilities. There are three net present values. So they want an average. If we never had the probabilities of these outcomes, then our average would have been take this plus this plus this divided by 3. Divide by 3. Divide by 3. So ladies and gentlemen, this time around we happen to be having probabilities of our outcomes. Probabilities of our outcomes. So what I need to do is to come and do a schedule here, to come and schedule my parameters. We have NPV 296.4, 505.87, 590.88, and then fortunately we have our probabilities which are associated with our durations. There is a table there just before required where they have given us probabilities. Like the probability for 5 years, useful life, is 0.2. The next probability, ladies and gentlemen, is 0.5. The next probability, ladies and gentlemen, is 0.3. Of course, it's good to do a simple test and ensure that the total probability adds up to 1. Now, having gotten this, I know that this is my x, this is my probability. I just need to come and create a column of xp there. We must attach the probabilities to our net present values here. So could you kindly do the multiplications for us? So the first one, remember, for us to be able to get x bar, which is the same as expected. Like in this case here, expected net present value. What I'll do is to take the x values times their corresponding probabilities, and then I sum like that. So we have the first one, which is 296.4 times 0.2, giving us 59.28. And then we have 505.87 times 0.5, giving us 252.94. And then, ladies and gentlemen, we have here 590.88 times 0.3, giving us 177.26 like that. So come and give us the total. So we have here, ladies and gentlemen, 59.28 plus 252.94 plus 177.26 equals, which gives us 489, point what here? 48. So this sum here is our expected net present value, which is 489.48. So I have to imagine that those figures, ladies and gentlemen, are correct. Those figures are what here? They are correct. Because of rounding off error, somebody could get 4649. The same, the same, the same, the same, the same, the same. So there we are. Number one is over. It can't be over, ladies and gentlemen, until you finish talking to us about the viability of this particular project on the basis of the expected net present value. So for me, I'll straight away mention their conclusion that the project is viable. Why is it viable? Because we have a positive expected net present value. We have a positive expected net present value. So that is it. So now we can go to Roman 2. Roman 2, they want us to give them the standard deviation of NPV. They want us to give them the standard deviation of net present value. So they want us to give them the standard deviation symbol is like this. At times I get students of mine writing standard deviation like this is very unprofessional. This is a mitochondrial. This is not our standard deviation. You simply write at a good zero and then you pull, and then you pull that particular tail, and then you pull that particular tail. Now, ladies and gentlemen, with whatever that we have here, our standard deviation formula, is there anybody who can guess for us how the standard deviation formula will look like? How our standard deviation formula will look like? Somebody give us the formula of standard deviation. Give us the formula of standard deviation. Give us the formula of standard deviation. Is there somebody who has been able to write anything there? Standard deviation, ladies and gentlemen, normally because of deviation, we talk of x minus x bar. X minus x bar. Division means subtraction of the data values from the mean. And then, ladies and gentlemen, this, because of the standardization, they want us to talk of standard deviation. Remember, as per definition, the deviations must be squared times their corresponding probabilities. And then at the end of the day, ladies and gentlemen, we do what here? We sum. At the end of the day, we sum. Because there are many of them. It cannot be called a standard deviation until you come and put a square root. If you can remember very well from our high school days, we used to say that standard deviation is a root mean square. A root mean square. Meaning that first of all, you get our normal deviations, you square them, you average means averaging. If probabilities were not there, we would have divided by n minus 1, if you recall, for averaging purposes. And then now we have the root, the square root, the square root. Now, ladies and gentlemen, I know most of us, because of the portfolio theory, we normally talk over expected, or rather returns minus blah, blah, blah. Those are returns of what year? Our returns in terms of what year? Portfolio. Here, this is the proper formula to use. So remember, what they want us to give them is the standard deviation of net present value. So come and create a column here of our x minus x bar. We square times probability. We square times probability. I would want to give you 1 minute, ladies and gentlemen, 1 minute, ladies and gentlemen, for you to do what here? For you to complete this particular column for me. Just 1 minute. Ladies and gentlemen, we have our x values here. So the x value, the first one on PK is 296.4. We have here 505.87. We have 590.88. We say minus, minus, minus x bar. X bar, we have our x bar. Our x bar is this 489. 489.48. 489.48. 489.48. I know some students will start subtracting these figures. No. Remember our x bar. From the definition, bar means uniform, average. So the x bar is not in advance and will be assumed to be constant regardless of the outcome. So ladies and gentlemen, here we are. Come and square for us Square there for us, square all this for us, multiply this with their corresponding probabilities. I hope my man here will be able to see my figures. The probabilities here are 0.2, 0.2, we have 0.5, we have here 0.3. So straight away, ladies and gentlemen, come and give us those values for those particular outcomes. There are three of them. If my space would have allowed me, I would have fixed those figures there. But because the space can't allow me, I just come and have the two x's there. And my figures are here, three of them. So I'll talk of on open brackets 296.4 minus 489.48. You say equals, you say squared times 0.2, which gives me 55.98. The second one will be 505.87 minus 489.48 equals squared times 0.5. I'm able to get a figure of 1343.16. The last one, open brackets for the last one, this will be 590.88 minus 489.48 close squared equals times 0.3. I'm able to get quite a huge figure. Don't know whether it's correct. 3084.59. After repeat the last one. Open brackets, we have 590.88 minus 498.48, close brackets there, squared equals times 0.3. What figure are they able to get? I don't have a very good calculator. What figure are they able to get in the last one? 25? The last one. What figure are they able to get? I'm waiting to hear from them.
So it's correct.
The figure is correct, eh? So then the first one, my calculator, I don't know. The second one, I mean, we have brackets 590.88 minus 489.48 squared times 0.3. Yes, it's correct. So please come and give us the total. And this will be called here total variation or total variance. Total variation or a total variance. Total variation or a total variance. So could you kindly give us an answer there? Please add for us. When you add for us, what shall we get at the end of the day?
The second one is 134.32.
Oh, the second one is 134.32 from one or two students.
From 3.
From 3, eh? So we have here 505.87 minus 489.48 squared equals times 0.5. 134.32 is correct. 134.32 is correct. 134.32. So I don't want to use my calculator again. Now come and give us the total variance. Please add the 3. Add the 3, give me the total variance. Add the 3, give me the total variance. What is the total variance?
No, 674.
106.
74.89.
Now, having gotten the total variance, come and give us the standard deviation. The standard deviation, of course, will be equal to the square root of this variance. Square root of the variance, which will be the square root of 10,674.89. Please give us an answer. So standard deviation will be the square root of these, which will end up giving us what parameter, ladies and gentlemen?
103.32.
So I'm being told by great students here that my standard deviation is 103.32. Thank you, and thank you very much. That is what this particular examiner wanted us, to ascertain the standard deviation of the expected net present value. I'm so sure that all of us would have gotten that correctly. Look at Roman number 3. Roman number 3, if the net present value of the project is less than 200,000, the farm will be exposed to a financial distress. Determine the probability that the farm will avoid financial distress, assuming a normal distribution. I want to give you 2 minutes. You try to think through this question. 2 minutes, try to think. Now, ladies and gentlemen, a normal distribution. Remember that bell-shaped curve that we used to encounter in CPA section 4 quantitative analysis. The bell-shaped curve, normal. Waswahili nasema ugali ya Mluya. Ugali ya Mluya ambayo iko very balanced. Kila mtu ako na talent yake. Wengine hatuwezi tukafanya ugali kwa balance hii, lakini kuna talent zingine. Kama ni Mswahili anajua kupika wali kabisa, lakini Mluya anajua. Hii ndio normal distribution, ugali ya Mluya. Now if you can remember from your section 3, ladies and gentlemen, a normal distribution, a normal curve is normally defined by 2 things. We have the mean, we have the standard deviation. So the mean here is 103.32. Or the standard deviation is 103.32. And then we have the mean. Mean is the same as this U is the same as the expected net present value in our case, expected mean. And unfortunately, you guys had given me a figure for the mean, which unfortunately I deleted. But I'm so sure you guys are great. You can still remind me. You can remind me. What is the expected NPV? Expected NPV. What is the expected NPV? Somebody 489 point something. 489 point something. Somebody talk to me. 489 point something. 489.48. Thank you very much. 489.48. Remember, all my figures here are in terms of thousands. So when you read the question, if the net present value of the project is less than 200, if the net present value of the project is less than 200,000, the farm will be exposed to a financial distress. So first of all, come on this axis of NPVs, come and mark where 200 is. My 200 is less than this. So my 200 is somewhere here, 200. So they're telling us, ladies and gentlemen, that if the net present value of the project is less than 200, I'm omitting the 3 zeros to be consistent with the one that we have here where we have chopped the 3 zeros, the farm will be exposed to a financial distress. Determine the probability that the farm will avoid financial distress. Remember, if it's a normal curve question, we must shade off some area. So either we shade off the area on the right or the area on the left. Which one, according to our understanding, do we think, ladies and gentlemen, should be shaded? Which area should we shade? The area on the right or the area on the left? The area on the right or the area on the left? The area on the right or the area on the left? Please talk to me. Which area should we shade? Left. Right or left? They are saying left, eh? 1 or 2 or 3 students? 2 students are saying left. Ladies and gentlemen, this one, if you're saying we shade on the left-hand side, thank you very much for trying, but you are offside. Because if our NPV is less than 200, ladies and gentlemen, we shall fall into financial problems. We shall fall into financial distress. But we want, in this case here, the area that will avoid us getting into problems. So in this case, ladies and gentlemen, if the net present value of the project is less than 200, if it is less than 200, fine, then the farm will be exposed to a financial distress. They want us to avoid that distress. Determine the probability that the farm will avoid financial distress. So you can only avoid financial distress if you are in this area. If we are in this area, and having discovered that, ladies and gentlemen, I know that the next thing will be for us to ascertain what we call the standardized, the Z-score. We get the Z-score. And the formula for our Z-score will be X minus U divided by standard deviation. X, ladies and gentlemen, X here on this axis will be any other figure apart from the mean. So X here is 200. So 200 minus the mean. 489.48. We divide this by the standard deviation, which is 103.32. So could you kindly give me this Z, ladies and gentlemen, kindly give me this Z. Our Z will be equal to what at the end of the day? Our Z will be equal to what at the end of the day? So please make sure you are doing your numerator computation first. 200 minus 49.48 equals. Whatever you get is what you divide that by 103.32, which will give us what figure? Somebody there? Negative 2.8. Is it 2.8? You know, we normally prefer Z-score to be in terms of 2 decimal places. Z-score is 2 decimal places. Z-score is 2 decimal places. 2.8. Thank you very much. Having gotten this, what I will do is to go to my question papers and read the entry. Read the entry from a table written normal curve or normal table. Go to our tables. There's a table there written normal. A table written normal there. This table written normal curve. This table written normal curve, ladies and gentlemen, I have my normal curve. I will go to a column called the 2.8. So walk down. Of course, I have the second one, or rather, I have another one here. 0. There's a 0 somewhere there, because I want 2.80. So we have this column titled 0, A, B, C, D, all the way. And then, of course, I want 2. So I locate 2.8 in the Z column. Please, in the Z column, locate 2.8. And then look for this digit 0. And then you read for us the figure that is here, the figure that is there, the figure that is there. I'm waiting, ladies and gentlemen, to hear whether there is anybody who will be able to read that figure nicely. To read that figure nicely. It's called an entry figure. Entry figure. Entry figure. If you read very, very keenly, you'll be able to see 0.4974. 0.4974. 0.4974. 0.4974. Is there anybody who is able to see 0.4974 there? Please, try. Try. Go to your normal. Is it a normal table? So it's a normal table. And you will get some other normal tables, although it's rare, although it has been brought before. You get some other normal tables where you read the 2.8 and you're able to get like 0.9. Like now this one will be 0. You get some other table telling you 0.9974.
Yes.
You're saying yes, eh? Yeah. Occasionally they give us that bad table. But the better table is the one that normally gives us the entry figure between the two values and the area of the two values that you have subtracted, these two values, here and here. This area that you have read should be this area. But fortunately, we know that this other area is what here? 0.5. 0.5. And at the end of the day, what would they want us to give them? They would want us to give them the total area, which is the same as what here? Our probability. So you add the two, which will end up giving us 0.9974. You add the two. So remember, when I'm reading my entries from my tables, I always disregard what here? Negatives. The Z-score, I'll disregard the negative, because basically negative is telling me that we have an area on the left-hand side. we have an area on the left-hand side. On the left-hand side, we have an area on the left-hand side. With the time they wrote as that bad table, although it's not bad as such, because for that table, which goes all the way to more than 0.5, more than 0.5, and got figures which are more than 0.5, that table, whatever you read, is your correct what here value. Whatever you read is your correct value, is your correct value. Don't make any adjustments. So could you kindly, ladies and gentlemen, at least for once, ask me a question. Ask me a question. Ask Mwalimu a question. So this total area is the probability of not being financially distressed. Ask me a question. Ask Mwalimu a question.
Please, how to get 0.4974?
You know, we have got the most common table, remember. If you have got your past papers there, try to look for another table. You realize that we have this table, ladies and gentlemen. When you go to the Z score, 2.8, 2.8. So of course we have here the second digit here. When you read that there straight away, you'll be able to get some most popular tables here. You'll be able to get what we call 0.4974. A table where they have shaded like this. When they shade like this, from the mean to the random variable like that, they give you figures which cannot even hit 5. So if you have this table, you simply get out that table, go to where you are seeing Z is 2.8, like that, you'll be able to see this. I know the kind of table you have is a table where they have shaded everything for us. They have shaded everything for us, meaning that they have included the 0.5 element, So this is a good question, which I can only answer if you have got that other table that you normally use too. Right? So I hope I've answered that question. As I wait for more questions there. Yes, I'm waiting for more questions. There's a student asking us, how do we get to know the table to use when you are doing present valuation? Remember, we have got two types of cash flows. We have cash flows, ladies and gentlemen, like now the scrap. We have here the scrap. This will be an amount which we call irregular or a lump sum amount actually. So if it is a lump sum amount, I will use that table called the present value interest factor of a lump sum. It's written up there, it's the first table normally. Present value interest factor of a lump sum amount. But what if in this case here I encountered annuities? Annuities, ladies and gentlemen, annuities, I will use what we call the PV, present value interest factor of an annuity. And I hope you remember what an annuity is. If, for example, in year 1 you're getting 10, year 2 10, year 3 10, etc. Then you are talking of what year? PV. PV is when you have somebody giving you like 10 this year, next year 20, another year different amount, or basically where you have a one-off figure, like what we are calling the scrap. You use PV. So I hope I've answered your question. And that means that you must have lost some topic. There's a topic that we did, not a topic, but just a topic about this, how to do the present valuation. But fortunately, now we have been able to connect you to all our videos. I hope you guys are able to enjoy our videos on that website, rcmpublishers.co.ke. rcmpublishers.co.ke. Is there somebody who has been able to get access to those videos? Is there someone who has been able to get access to those videos? If you provided your email addresses, of course, we have connected you. You just check your email. We sent the login credentials there. We want to see from the comment section whether there is anybody who has been able to access those videos.
Yes.
Yes. And please don't jump any video. When you're watching them, you have to follow them. If it's video 1, you finish, you go to video 2. And then of course at the back end, I'm able to see your progress. I'm able to see your progress, which of course I'll be giving you what we call a progress report. At the end of the month, you'll be getting a progress report. I'll be able to tell you that you are doing these things very fast, or you are very, very slow. Those students will not ever get time to watch. But just create, even if it's over lunch hour, simply watch a whole video as you take your notes. Remember, that's a normal class. That's a normal class. That is quite wanafunzi wa Summit. Wanafunzi wa Summit, the arrangement I have with Summit is for the live classes. It's for the live classes. I'm sorry, that is for the live classes. Normally this one for videos is quite costly because of what here? Systems administrator. The systems administrator takes about 30% of what the students pay. The students normally pay 3,400. The systems people for doing the uploading like that, they take 30% of that, which is about 1,000 shillings. But for you, I'll have to discuss with the management, and then I'll be able to tell you the way forward. The way forward. Okay, so ladies and gentlemen, because I can see I'm not well within the time, I can't start any question. How many minutes do I have to 7:30? 14 minutes. What we can do is simply do few illustrations here and there. Few illustrations here and there. Like if for example here you have like when you visit what this student wanted. If for example somebody, we have here ABC, just an illustration. ABC Limited expects to receive Kenya shillings 10 million per annum for 5 years. And then they have given us the cost of capital. The cost of capital is 10%. We are required to determine the total present value of ABC Limited. 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 I'm giving you exactly 3 minutes. 3 minutes. Please give me the total present value of ABC Limited. Okay, so ladies and gentlemen, here we are. The first thing that we have to recognize is that we are talking of what, ladies and gentlemen? We are talking of an amount that is regular. And if this amount is regular, every year we're getting 10 million, 10 million, 10 million like that, then it's an annuity. And if it's an annuity, then for discounting purposes, I will need to calculate what we call PVFA. PVFA is present value, interest factor of an annuity. Present value, interest factor of an annuity. So this present value, interest factor of an annuity will be 1 minus, remember our simpler formula. 1 minus our simple formula, which is 1 plus R, raised to the negative n, everything divided by what here R, and of course as a good student of finance, these are formulas I need to know. But I don't have to cram it because the formula is normally given on your tables there. But it's good to know how to work around with it. So R is the cost of capital. So then what we have here is 1 minus 1.1. Because our cost of capital is 10%, 10% is the same as 0.1. So it will be 1 plus 0.1. So 1 plus 0.1, this will be 1.1 raised to negative n, where n in this case here will be 5. N is 5. This one here divided by our R. Divided by our R, where our R, ladies and gentlemen, our R, the cost of capital is what here somebody is 0.1. Where the cost of capital is 0.1. Where the cost of capital is 0.1. So then what we have here, somebody get your calculator, say 1 minus 1.1 raised to minus 5. 1 minus 1.1 raised to minus 5. Whatever we get, we divide by 0.1. 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 Somebody give us something there. So 1 minus 1.1 raised to that, divided by 0.1. Waiting for an answer. Somebody, what do we have there? Somebody. It can be 0. It should be 1 minus 1.1 raised to minus 5.
3.7908.
3.7908.
7908.
Thank you, and thank you very much. Now, having gotten that, ladies and gentlemen, then what we will do to get the total present value is quite easy. To get the total present value, the total present value, you will take the annuity amount multiplied by PV factor. You will take the annuity amount multiplied by PV factor. So the annuity amount, what do we have here? The annuity amount receivable is 10 million per annum, multiplied by our PV factor, which is 3.7908. Then this will end up giving us a present value of 37.908, like that. That's quite important. That is quite important. That is quite important. That is quite important. This is quite important for you to understand. How about this one? We have XYZ limited, XYZ limited expects to receive Kenya shillings 20 million per annum indefinitely, or what at times you examine every semester. He has to bring this concept of indefinite cash flow, perpetuity. At times they call it in perpetuity per annum indefinitely. And then they have given us the cost of capital. The cost of capital, ladies and gentlemen, is 10%. The cost of capital is 10%. The cost of capital is 10%. So we are required to determine the present value. Determine present value. Determine present value. Determine present value. Indefinite cash flow. Ladies and gentlemen, for indefinite cash flow, what do we have here for indefinite cash flow? So long as it's an annuity, I will start first of all by remembering my annuity formula. I'll start by remembering my annuity formula. My annuity formula, ladies and gentlemen, reads like this. My annuity discounting formula is 1 minus 1 plus R raised to negative n, and then you divide everything with what here? Somebody with R. You divide everything with R. Now, ladies and gentlemen, if this is the case, remember our n is infinity. Our n is indefinite. So if this is an indefinite parameter, it means at the end of the day, this entire term will tend towards 0. This entire term here, which has got a connection with infinity, has to disappear. And that is why they normally tell us that the present value interest factor of an annuity that is infinite, is normally obtained by us talking of what here? Somebody 1 over R. And therefore, our total present value for an amount receivable indefinitely will be equal to the annuity amount multiplied by our PV factor, which is 1 over R. Annuity amount multiplied by our 1 plus R. 1 over R, 1 over R. So, ladies and gentlemen, if you're keen enough, you must have realized that this one will end up giving us A all over R. So the amount receivable is 20 million. Divided by R is the cost of capital or the required rate of return. The required rate of return here is 0.2. So then what is 20 million divided by 0.2? Somebody talked to us this morning. talked to us this morning. Somebody talked to us this morning. So 20 million divided by 0.2 gives us what here, somebody? 400 million. Thank you very much. The last one for today. The last one for today. The last one for today, ladies and gentlemen, is again illustration 3. Illustration 3. We have X, Y, Z expects to receive Kenya shillings 18 million per annum, whose growth rate is 3% per annum. Yeah, the cost of capital is 21%. So we are required, ladies and gentlemen, to determine the total present value. We are required here to determine the total present value. 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 So, ladies and gentlemen, how will I be able to get my total present value? Quite easy. You will realize that in this question, they have not given us the period. N is infinity. And if it's infinity, ladies and gentlemen, what I will do is to come and give them total present value when N is not given. Infinity is amount over R. Amount over R. But now this time around, there is a foreigner. We have a growth rate. Whenever there is a growth rate, the amount has to be grown. And then at the end of the day, this growth rate, we have to adjust the denominator with it by subtracting that. So the total present value equals amount into 1 plus the growth rate all over R minus the growth rate. So the amount we expect to get here is 18 million into 1 plus the growth rate, which is 0.03. All over the required rate of return is the cost of capital. The capital providers will need something in return. All over, in this case here, our R, which is 0.21, minus the growth rate again, which is 0.03, minus the growth rate, which is 0.03. So we have here 18 times 1.03, 18 times 1.03, whatever we get, we have our denominator. You have to subtract. And then now you give us the question. You give us the answer. As we disappear, want to disappear now. And I would like to take this opportunity to thank all those students who decided that Mwalimu, we need an early morning class. You actually gave me a job because most of the times I was just sleeping in the morning. You gave me a job. And now because you've given me a job, which I would want to be doing every morning, I would want us to roll over all the classes of section 5 in early morning. But provided you guys look for numbers for us. I would want great big numbers. Big numbers, say 50. That's how now you give me a meaningful job. You give Mwalimu a job. Finally, you've given me the job. You see the jobs which are not meaningful. Like if you give me a job where if I don't have a vehicle, I can't even afford a matter to have to walk all the way along Thika Road to industrial area. That's not a very good job. Give me a meaningful job by giving me many students. So top of 18 times, have they given us an answer?
The last answer was 103 million.
103 million. Somebody is giving me a figure of 103 million. Ladies and gentlemen, remember this perpetuity thing. This perpetuity thing is the one that gave birth. This is the one that gave birth. This is the one that gave birth to valuation. It gave birth here. It gave birth to valuation concepts. Valuation. All valuation concepts are pegged on this. Like how do we value ordinary shares? To value ordinary shares, ladies and gentlemen, we normally talk of PO. Provincial officer equals district officer into 1 plus growth rate all over Kenya minus government. PO. PO is the current market price per share. DO is like my amount here. DO is the current dividend per share. It's 1 plus G all over KE minus growth rate. KE is the cost of equity holders, same as cost of capital. So you can see that this is quite similar to this. And it's similar to this because we normally assume that any organization that is selling their shares outside there will stay with us indefinitely, in perpetuity. So, and this, of course, formula gives us a very good base for valuation of ordinary shares, and of course, for our major topic called advanced financing decision. And that is why we guys need to be good in topic number 1 for us to be able to score moving forward, because there is a whole chapter called what you evaluate, valuation of companies, valuation of businesses. So, ladies and gentlemen, that is it. For the students, in this case, you are asking how they can access these videos as I consult. Perhaps you could get, you could try reaching out to me. We get to see how we can help each other, because also these live classes alone will not really be able to ensure that we shall finish syllabuses before 21st of September. So all students who want these videos can try reaching out to me through WhatsApp or even calling as I try to work it out. Yes.
20 million over 0.2. How did you get 400 million?
20 million. 20 million divided by 0. You know, I got this answer from you because I don't have a calculator. I got the answer from you. Just use your calculator. It can be 400. Use your calculator. 20 divided by 0.2. Use your calculators. It's supposed to be 100 million. It's supposed to be 100 million. It's supposed to be 100 million. Now we should correct it as that time because this video is going to circulate. But it's also part of the game. It's part of the game. Otherwise, thank you very much. Kindly have a lovely day. We shall be meeting next week for the early morning classes. For the students who are coming for the other programs, please ensure that you also attend those other programs. Thank you very much. Any other general question? Thank you. Good day. And I hope you have enjoyed the lesson.